The biggest question this week is not whether investors can still find good news. They can. Nvidia just delivered the kind of earnings report that, in a different macro environment, would probably have been treated as a full green light for risk. The S&P 500 earnings season is still coming in far better than expected, and Bitcoin, despite meaningful ETF outflows, is still holding around 78K rather than breaking down in a disorderly way. But I think the more important tension is this. Good news is no longer automatically translating into broad risk appetite. The Fed minutes last week reminded markets that the next policy move is not necessarily going to be a cut. Nvidia reminded markets that AI CapEx is still extraordinary, but also that valuations may already be asking a lot. ETF flows reminded crypto investors that institutional demand is not a constant bid. And finally, tokenized equities last week reminded everyone that putting assets on-chain doesn't magically answer the question of whether token holders actually own the asset. So I think the key theme this week is really going to be about constraints. Macro is constraining liquidity, valuation is constraining equity upside, ETF outflows are constraining crypto beta, and regulation is constraining tokenization. Now, none of that means that the market has to fall apart, but it does mean that the bar for a broad liquidity-led rally is a lot higher. But we'll break it all down in today's show. Let's get into it. Welcome back, everyone, to the Coinbase Markets Podcast. I'm Colin Basco, a quantitative strategist at Coinbase, and I'm joined today by Josh Pack, a senior trader on the Prime Trading Desk. I want to start with the Fed, because in my view, the April FOMC minutes were one of the most important macro developments for crypto last week, not because they revealed some brand new hawkish shock, but because they made it much harder for markets to keep treating the policy path as a one-way road toward cuts. The Fed held the target range, but the discussion underneath the decision was much more two-sided than the rate decision alone suggests. A majority of the participants said that additional policy firming could become appropriate if inflation continued to run persistently above 2%. Many of the participants also wanted to remove language that implied an easing bias. So I think the key takeaway is that the Fed's reaction function has become far more conditional on energy, inflation expectations, and whether the supply shock starts to look like a long-term problem. So I think there are two scenarios here. First, if the market believes that the Fed is only waiting for confirmation that inflation is coming down, then weak growth or softer labor data can be treated as liquidity positive. But on the other hand, if the Fed is worried that higher energy prices, tariffs, and broader input cost pressures could keep inflation sticky, then I think the market has to reprice the entire left tail and the right tail at the same time. I think then weak growth is no longer automatically bullish if inflation is no longer cooperating. Josh, I'd love to get your take here. Do you think that the minutes marked a genuine shift in the Fed's reaction function, or did they mostly validate what oil break-evens and the rates market were already telling investors?
Yeah. Hey, Colin. Great to be here. I think the Fed minutes basically confirmed what bonds and oil had already been telling us, that inflation doesn't look to be coming down and that the Fed knows it. So between the Iran situation, you have higher energy prices and tariffs are still feeding through our market. I think that 2% target on inflation feels further away almost than ever. And I think the bigger story is the Fed's mindset has now almost completely flipped, at least from what I can tell. They walked into 2026 debating, when was the right time to cut, what the pace of those cuts should be. And now they're debating whether rates are even high enough. So I think, with markets pricing in a 75% chance of a hike by year end, it feels to me that the conversation has totally shifted from when do we ease to now when do we hike?
Yeah, and for newer listeners, I think the simple way to think about this is that crypto is highly sensitive to the discount rate environment, because when expected real rates rise, cash becomes more competitive and the hurdle rate for the speculative assets goes up. And longer duration narratives have to start competing with a more attractive risk-free alternative. Now, that doesn't mean that Bitcoin mechanically will fall every time that yields rise, but it does mean that the broader altcoin sector, especially assets without clear cash flows or near-term catalysts, they're going to have a lot harder time attracting marginal capital. I think this also matters through leverage, because higher expected policy rates and tighter dollar liquidity can pressure basis trades, funding conditions, and leverage positioning across crypto. Because when cash yields remain unattractive and macro uncertainty is pretty high, then investors don't really need to reach as aggressively for beta. So Josh, from your seat in prime trading, are clients treating this rates repricing mostly as a macro overlay, or is it actually directly changing how they size leverage, basis trades, or really their altcoin exposure more broadly?
Yeah, I mean, that's a very interesting question. I think from our seat, it does look to us that clients are treating the hawkish Fed repricing almost strictly as background noise, from what we can tell. And I say that because if they were genuinely spooked by this shift in rates, I think what we would expect to see is a textbook macro de-risking. You'd see this unwinding of leverage, closing out a basis, and this rotation of capital back into the relatively safer coins like Bitcoin and stable coins. But I think from what we see, we're actually seeing the exact opposite of that, right? Bitcoin, of course, has its own structural tailwinds and narratives that help reinforce its own price action. But we are actually continuing to see structural narratives in thematics that have been, talked about, well discussed here on this show, including privacy, perp dexes, and on-chain lending, that are continuing to drive liquidity into non-BTC assets during this same window.
Yeah, I think if we could split the implication into two different time horizons, I think in the short term, this is probably going to be a headwind for broader crypto liquidity. But I agree. I do think that there are some individual sectors like privacy and the AI narrative that are able to break out idiosyncratically against Bitcoin. But I think in the longer term, it makes the market more conditional, because if oil rolls over and inflation expectations stay anchored, then I think the Fed can regain their optionality. And I think in that scenario, we can see altcoins and other individual, smaller narratives start to actually increase and gain more marginal capital. But I think if energy remains elevated and core inflation pretty sticky, then I think the macro backdrop becomes a lot less friendly for a broader risk rally. And I think in that scenario, Bitcoin dominance most likely continues to trend up. But that said, I think the Fed isn't the only dominant driver here that's moving markets, because obviously equities are going crazy. So let's pivot and talk about Nvidia and equities, because they've been holding up unusually well despite the whole inflation scare. And for people that don't know, last week, Nvidia reported revenue up 85% year over year, with data center revenue up 92% year over year. Now, that's a pretty extraordinary set of numbers. And I think by now, Nvidia's sort of become the market's most clean and clear read-through on where exactly the AI CapEx cycle is going and if it's still real. And for now, I think the answer from a fundamentals perspective does appear to be the case, where hyperscalers, AI clouds, enterprise infrastructure, and the whole build out, that spending is very high and people are still spending very aggressively in each of those fields. So Josh, what did you think about these earnings results? Do you think investors are actually treating Nvidia's results as a broad risk on signal, or are they increasingly treating Nvidia as more of a narrow quality trade that doesn't necessarily automatically spill over into crypto and some of these other higher beta assets?
Yeah, I mean, that's, of course, a huge question given Nvidia's, impact on this market today. If I recall correctly, I think equities traded slightly lower following those numbers. It's, I think, very difficult to know how much spillover that we can expect in our market. But Bitcoin during that same window actually traded roughly 2% higher than Nvidia in the aftermath, which I think to a certain extent says, a good amount about that these two assets are clearly moving on their own idiosyncratic narratives right now. I think really the overarching common thread underneath both of these is really geopolitical in nature, specifically around Iran. So I think anything that happens in developments in Iran, I think that will be the larger macro event that really impacts both Nvidia, AI hyperscalers, as well as Bitcoin and general risk.
Yeah, I definitely agree with that. And like you mentioned, I think Bitcoin improved a little bit. After that, Nvidia also pulled back a little bit after their earnings call. But the broader market reaction was pretty interesting, because the S&P actually made a new all-time high again. And realistically, equities in general have done quite well since then, including today. So if we take a little bit of a deeper look at the earnings data for Q1, it's pretty remarkable. So FactSet does a pretty good job of aggregating a lot of the different earnings data. And based off of their analysis, the S&P 500 index is tracking a blended earnings growth rate of 28% for Q1, which is actually the highest level since late 2021. And 84% of those companies have beaten EPS estimates, and 81% have beaten their revenue estimates. So that's a pretty remarkable earnings season. But at the same time, Obviously, the market is still expensive. So a lot of people have always been calling, is this going to be a market top? The forward 12-month PE ratio for the S&P is around 21, which is above both its 5-year and its 10-year averages. So I think investors are really looking at an economy where earnings are strong, AI CapEx is strong, margins are strong, but the discount rate is also higher and the multiple is also already elevated. So I think the reason why this is really important for crypto is that it really helps explain why equities can outperform while most of crypto remains relatively stagnant, because equities actually do have a very strong earnings story right now. Crypto, outside of a few specific tokens, don't really have the same sort of earnings and net profit story that equities currently have. I think right now, crypto has to rely more heavily on things like liquidity, flows, adoption narratives, market structure, and in some cases, protocol level fee generation. So that's why I think we're seeing Hyperliquid, for example, being one of those tokens that is able to idiosyncratically break out against Bitcoin. So I think right now, AI is serving more as a liquidity tailwind for equities, but it may also be a valuation stress test for everything else. So for crypto, I think the AI read-through here is especially complicated because on one hand, you have a durable AI CapEx cycle that supports risk appetite and helps AI adjacent crypto narratives stay relevant. For example, you saw, FET also breaking out today, like Tau. A lot of the AI names in crypto are doing well. But on the other hand, if investors are narrowing their exposure to the highest quality growth names, then other themed tokens don't automatically benefit. And a good example of this right now in crypto are tokens like Solana, which aren't even getting that much of a bid despite all of the new Alpenglow news. So I think it also depends on what the actual catalyst is. Not all catalysts are being treated as bullish catalysts in this environment. It seems very selective. So Josh, when you look at this relative performance comparison, do you think crypto is lagging equities mainly because of macro liquidity or because ETF flows have weakened, or, what exactly do you think it is?
That's a great question. I think as you just mentioned a couple lines ago, the equity story has been really compelling because fundamental growth looks to be genuinely outpacing the drag of these higher interest rates. When you look at companies like Nvidia, they're generating cash flows that are so extraordinary, almost, we're just used to it at this point, that they override the overall macro tightening narrative. Crypto, to your point, just doesn't have that same narrative and that earnings cushion. And I think with liquidity conditions in general less favorable than what they were a month or two ago, that marginal buyer that we may have seen step into this market, they've stepped back. And I think they're just taking on a little bit more of a defensive posture. And there are, to be frank, I think perceived safer places to hide right now in equities and large and mega cap equities. Better than crypto. But I think the silver lining here is this. I think that, despite a higher risk-free rate, you're seeing delayed rate cuts, rate hikes, as we're talking about here, ETF outflows, and really still Bitcoin is holding up okay here. And the bottom has not fallen out, I think, the way that we may have expected, a couple months previously. And I think that structural resilience really tells us that smart money in this space is treating this just as a consolidation phase. This happens in crypto. It's highly cyclical at times. And when macro conditions do turn, I guess the upside here would be that crypto won't need to wait for a quarterly earnings number to justify the next leg higher. So we're just in a little bit of a wait and see mode.
Yeah, I definitely agree. And to pull it back to like data and trying to quantify like what exactly is going on, like why are we consolidating? I think one of the metrics that we can look at are ETF outflows and inflows, because now they actually quantify the lack of interest in crypto at the moment. They're a good, useful spot demand gauge. And from what we've seen, both spot Bitcoin and Ethereum ETFs saw net outflows over the past 5 business days. So I think the easy interpretation is for people to just, very easily say that ETF outflows are bearish. And directionally, yes, but persistent outflows can remove a source of passive demand. But I think the better question is, are these outflows being absorbed, or are they a warning that price action is more fragile than it looks? And I think that's a debate that investors should be having, since we haven't really seen a large breakdown in Bitcoin price, even though we've seen a lot of outflows. So Josh, what do you think here? When price holds, even though outflows are persistent, do you usually read that as a healthy absorption signal, or do you worry that it's delayed fragility that might show up before? or after price catches up?
I mean, I think to me, it looks like healthy absorption. I'm looking at the 2-week numbers to your point. It's $2.26 billion in Bitcoin, call it $1.7 billion in ETH. And prices are holding up fine here. I mean, I know, everyone in this market wants to see us holding above 85, of course, but I think price is doing what they're doing today relative to these outflows, and not seeing that expected sharp move lower based on those flows, I think just reinforces my view that this looks to me like healthy absorption.
Yeah. And to be clear for people, like ETF outflows and inflows, they can affect crypto through several different channels at once. So to explain exactly why, there's a couple of different channels you have to think about. The first is the direct spot demand channel, which is pretty self-explanatory. It's just people that are buying the ETFs instead of spot Bitcoin so that they can have directional exposure to Bitcoin's price moves. So in this case, if you were to only stop here, then you would make the assumption that any inflows or outflows of Bitcoin should have some direct correlation with price. But that misses the second channel, which is the basis channel. And here ETF demand can support the cash and carry trades because institutions can use spot products and futures markets to express a relative value position that's delta neutral, which means they're not taking a directional view on the market. So for example, they may long the ETF and then short a futures contract, in which case they don't want directional exposure, in which case a large inflow in ETFs doesn't necessarily mean that institutions or people that are buying these institutional products want Bitcoin to go up. They just might be expressing some sort of delta neutral component. But then there's also that component where sentiment can be influenced based off of the data, in which case large inflows can make it easier for the market to psychologically believe that institutional adoption is compounding because of inflows, whereas the reverse would happen with outflows where it creates doubt. So that's where it gets a little bit complicated. There's not necessarily going to be a very clear way always of using ETF demand alone or ETF signals alone as a leading indicator for Bitcoin price, which is kind of why we're sort of cross-referencing it with the discussion of where price actually is. And in this case, even though there were a lot of outflows, price itself hasn't really deteriorated significantly. So that's where I think a lot of other signals also are useful to look at in combination. So one thing is option skew, and option skew now has started to look a lot less defensive recently. So it seems like traders aren't expecting a panic crash anymore. So I think that's good because after the breakdown last week in response to the inflation data, that's when we saw people getting a little bit worried and option skew getting a lot more defensive. Luckily, a lot of that has been improving recently. And then there's also the question of cost basis, where Bitcoin is trading right now right under the short-term holder cost basis, which is at around 78K. And it's basically right at the 50-day moving average. So hopefully we see it hold here. And for people that haven't really been following along in terms of what the cost basis is, just very simply, cost basis levels can shape behavior because markets will often, they'll often struggle when a large cohort of recent buyers are underwater and are waiting for a chance to reduce their exposure. So whenever we're trading above the cost basis line, that's generally a lot better in terms of market sentiment and psychology there. So I think from here, to be constructive, what I'd personally be looking for are, ETF outflows to slow and to reverse, for Bitcoin to at least hold the 50-day moving average and ideally reclaim the short-term holder cost basis, and for funding rates to remain relatively healthy because we don't want like a huge leverage push because while short liquidations can help start trending moves, we don't want it to be the only catalyst for starting a trending move. But overall, I'd say positioning right now, we're sort of in like a consolidation phase like Josh mentioned. But enough on Bitcoin. Let's close with tokenized equities. I think this is one of the more important long-term market structure stories, even though it may not be driving prices in the short term. I think last week, the SEC delayed its exemption for tokenized stocks. And I think most of the problems centered on 4 central questions. I think first, would tokenized stocks convey dividends and voting rights? Second, could the third parties issue tokens without the consent of the public company? Third was, how would ownership be verified on public blockchains? And fourth was, should synthetic stock tokens be treated differently from tokens backed by actual equity interests? So basically, all of this just boils down to what exactly do the token holders own? And I think that sounds basic, but it is really the whole issue. If a token's a direct or indirect representation of a real security with rights, custody, and transfer mechanics properly handled, then I think tokenization can improve efficiency in a lot of ways. But if a token only provides synthetic exposure to a stock price without any voting rights or dividend rights or really any clear claim on the underlying asset, then I think it's a very different product. So Josh, on tokenized equities, what do you think investors most underestimate? The legal rights question, the issuer consent question, or the secondary market liquidity question?
Yeah, I mean, I think the legal rights and issuer consent question, both those questions, they get a lot of attention because those are, of course, boxes you in theory have to check. But I think the bigger assumption that nobody's really challenging outside of crypto native circles is this idea that bringing things on chain equals liquidity right away. And that's just fundamentally not true. And we see this often with crypto assets. The real issue isn't that liquidity is just thin and that it's going to get better, that you'll add more market makers to the mix, et cetera. It's that really that fragmentation and liquidity feels very structural. The same Tesla stock can exist on 3 separate and legally distinct blockchains or sit as 3 legally distinct instruments because they're trading on 3 different blockchains. And those pools never consolidate because they're not actually the same instrument. So in this case, I think the bigger issue is that just because there's more adoption, it doesn't necessarily mean that there's a deeper market. It just actually creates deeper silos. And until there's a single standard and a single instrument, a single tokenized equity instrument, these less efficient pools, we need to have these less efficient pools converge into one for the liquidity gap to really disappear. Because today you don't see that same issue in listed stocks.
Yeah, that's a great point. And it's just unfortunate that this delay, comes right now because I think so many people are very interested in investing in stocks right now. And I think the ownership question could be very ultimately a good thing for the industry as a whole because, clarification is always good to have in the long run. But I do think that the long-term upside still remains meaningful for crypto. Tokenized securities could eventually make stablecoins far more central to settlement. I think it creates additional new collateral markets. It'll be really beneficial for extending trading hours. So right now it's a little bit tough to, trade your favorite stocks at any time of the day. But, with crypto, additionally, that could be potential liquidity at any point in time. So I think overall, all this should be structurally positive in the long run once all of this is figured out. But I think that's a good place to leave it. So tying this all together, I think this week was more about the market demanding more proof. The Fed minutes demanded more proof that inflation is falling before markets can price an easing cycle. Nvidia demanded more proof that extraordinary AI earnings can still broaden into risk appetite outside of equities. ETF outflows are demanding more proof that Bitcoin and other Ethereum can absorb weaker passive demand. And I think tokenized equities are demanding more proof that on-chain products can preserve the rights and protections that investors are already expecting from traditional securities. So investors, I think, the couple of different things that you want to keep watch of over the next couple of weeks. I think on the macro side, obviously keep watch of oil and inflation expectations plus real yields in the dollar. I think those are going to be the biggest leading indicators for how markets abroad are going to be repricing risk. On the equity side, I would keep watch on whether AI strength continues to broaden or whether leadership narrows further. I think in crypto, a lot of the AI names are doing really well this week, plus Zcash on the privacy side. So we would want to see whether or not crypto is able to attract more marginal capital in some of the other narratives like Solana or Ethereum. On the crypto side, more broadly speaking, I would watch for ETF flows, funding, option skew, and whether Bitcoin can hold some of these key levels that we're discussing. I think one of the most immediate short-term levels is the short-term holders cost basis. So I think if we were to reclaim the short-term holders cost basis, that would be a much more bullish signal. Right now, I think we're sort of just chopping around in no man's land. That said, I don't think none of this produces a clean bullish or bearish answer. Unfortunately, I think it's more of a realistic takeaway to remain, cautious here. Josh, really appreciate you joining today and helping us think through the trading and market structure side of all of this. And thanks to everyone listening to the Coinbase Markets podcast. If you enjoyed the episode, please leave us a like, leave a comment, and follow the show. See you next week.
All statements and analysis correspond to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Prior results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third-party investment strategies or digital assets or any website or content related thereto.